Thank you all for attending this session. The whole idea of this session is how to understand the ESOPs more critically, which includes any type of stock options, be it as RSU, ESPP, or anything. The idea is most of the times what we have seen that employees always have think that okay, these stocks are given at zero cost, so they not take on a overall consideration as a part of their overall thing. And secondly, for many of the employees, how to select a companies based on the ESOPs policy also make a lot of difference, because over a period of a time, one thing what we have seen that majority of employees who have created the wealth, ESOPs play a very major role for the wealth creation perspective, and especially as India is becoming a startup hub and a lot of new companies are coming up with the ESOPs policies on the startup side, apart from the regular IT companies. We have seen that it's worked out well. And the recent example of the Flipkart, the way majority of the employees got the benefit of ESOP by the Flipkart. So at least in Bangalore, we will have seen that how ESOPs play a major role. And our whole idea is that how we can maximize value through different exercise strategies and planning perspective. Now I'll just take things forward. So typically these options comes in the mind. So the moment somebody have a ESOPs like hold till the purpose, invest into real estate, utilize, redeem or invest, or what should be the ideal thing needs to be doing it, or utilize for their goals, or invest into the new avenue. So there always be a question in the mind that what should be we will be doing it once we have ESOPs to exercise. So I think the first foremost thing which we always say that investment decision should be based on your financial goals and looking at the tax consideration, and how the overall ESOPs work, because that is the most important part to understand that based on each company have their own ESOP policies. Based on that, they get approval and grant the options, and there'll be a vesting period. So based on the vesting period, you can exercise the ESOP. So somebody who's looking at to get the ESOP, he has to understand that there will be a different vesting period, and based on the duration, the ESOPs will be given. So these are the stages involved in granting ESOPs. One is the grant date, is the date when ESOPs given. Then the exercise price, when it can be exercised, exercise date, and the period for which option to buy the share. So there will be a specific time period given within which somebody needs to buy it, and then the wasting of the ESOP. So here also the most important part, many times people are not keeping track of the exercise period, and once exercise period over, so your ESOPs can be lapsed. So that is the most important part which somebody needs to look at when they have the ESOP. The second most important part which comes in this, that once the ESOPs has been granted, after that when they are going to exercise, so they have to plan for the liquidity, because initially you have to pay for the FBT, the tax of what will be the difference in the price. So that also is something which somebody has to plan it earlier, because most of the time what we have seen that people end up selling their investments, and that is something which impact them two way. One is selling existing investment, stop their compounding effect, and they end up paying the tax on the existing investment also. Secondly, they are losing in terms of the whole growth of investment also. So I think if someone hold ESOP, he is to have a plan that how he is going to arrange the liquidity, because it requires from a short-term purpose liquidity arrangement. One of the unique thing which we believe somebody can utilize from a ESOP to generate the liquidity to pay the tax. One is they can take a short-term loan, especially against mutual funds and stocks, which will be very low cost compared to taking a personal loan. Another thing which can be get around 10% around cost, provided looking at that there is no exit clause. So somebody needs to look at the conditions while taking these type of a short-term loan. Another thing, which if somebody do a smart planning, like most of the people have a home loan. So we normally suggest that people who are have a home loan, they can look at to take the max gain policy of SBI specifically have. Apart from that, BOB and other banks also have, but SBI is very known for this max gain policy. So somebody who have a requirement from a regular perspective for liquidity purpose, max gain policy could be a very interesting thing to utilize, because they can have their ideal cash keeping it there, and whenever they needs to pay the FBT, they can take the cash from there, and whenever they exit from those ESOPs, they can again put it back money into their max gain account, so that they don't lose out on the investments, and plus the tax implication also doesn't come on the higher side. So sometimes it's all about how we do a planning, because planning play a very major role while we are doing the whole exercise. And the next important part which come, that when we are going to exercise, many of the times what we have seen that they just go with the exercise period. The moment they are coming near to expiry, they try to go for exercise instead of looking at the market price. Because if you exercise when price is lower, overall your capital gain will be on the lower side. So that also is the most important part where we play a major role. Like for example, if you look at most of the IT company stocks, be it Infosys and other Indian IT companies, they are currently at a lower price. Same way, if I look at today global stocks, global IT or most of the tech companies, they are on a higher side. So it always makes us sense that looking at the overall pricing, somebody should take a call. So if someone who have option to exercise Indian IT stocks, it make a lot of sense for them to exercise this today, because they are available at a good price. So same way, for example, for a global tech, it may not make sense now to go it, because today they are at reach out to their peak. So from here, the downside risk may be on the higher side. So even if somebody wants to do it, maybe he can do it in a phased manner. So I think that also play a very major role in terms of how somebody should plan for the liquidity. The another part, many of the IT companies, especially on the global side, they have a ESPP option, like Adobe at least, which is very well known for the ESPP option, where company provide the stocks at 15 to 20% lower price. Many times, many employees who are not aware that how it can work well for them effectively, they may not apply for these options. So it make a lot of sense if someone have a ESPP option, and as a overall company is doing good, so they can get the two level advantage. One is getting a stocks at a lower level, plus over a period of a time with the growth of the company, they get the appreciation also. These are the different evaluating the step parameter. One is the cliff period where ESOPs before the waiting, typically it's a benchmark 1 year. Then vesting period, which we have discussed, exercise period, when you exercise, and the ESOP pool is typically, which have keep for the purpose, is typically 10 to 15% of the total pool. They keep it on the ESOPs. The idea is to look at how it can added value to the employees. What are the different types of ESOPs? So, for example, one is employee stock option plan, RSUs, phantom shares, and then we have something called employee shares purchase plan, which is ESPP. So ESOPs, particularly, it's a right to purchase. It is not that you own it after vesting period, then you can decide to purchase. RSUs where they are being given, but before giving it, there are certain conditions which needs to be fulfilled. Typically, offer for the companies which are going to public or reach a stable valuation. So most of the large IT company like Wipro and other give RSUs. Phantom share, which is typically we have not seen many of the company are giving, where you get the benefit of stock ownership without owning the stock. So typically MNC structure wherein profit is paying in cash form after vesting is complete, so that companies don't need to go through multiple compliances. Last is ESPP, so wherein given as at a discounted price for the thing, like as I told, Adobe typically have these type of policy for employees apart from the RSUs and ESPP. So the most important part come how we can generate a wealth creation with ESOP. So I think there the most important thing which we have to look at and understand is first foremost what is our liabilities. So one thing which we always say as a part of financial planning perspective, that someone who is looking at to utilize the money, first they have to look at their liabilities part. Secondly, looking at their goals, because all those allocations should be based on their financial goals. And many of the times where if their kids are planning abroad education perspective, so for them also it makes sense to have some allocation in the global stock. So we don't suggest that okay, once you have ESOPs allocation you just exit it. So sometimes for the companies which are doing good, it make a lot of sense to hold it and plan exit based on your requirement of the fund, so you don't have a risk in terms of losing out of the currency appreciation, especially in the dollar term. So especially for a kids education perspective also, ESOP can be plan it very effectively. The third part it's come in terms of the diversification. So what we have seen that many a times people see that okay, I am holding a ESOP, that's the highest wealth creation thing, but that may not necessary all the time. So take an example, like for example, last 1 year, if I look at stock of Amazon, which have not done comparatively well. If I look at comparatively Apple, Microsoft, or Nasdaq index, or we look at the Indian stocks. So sometimes companies go through a bad phase also. So it's not necessary that company which delivered a very good wealth creation, it may continue in the same way. So for us, based on our goals and requirement, we should plan and diversify it so that tomorrow it should not become a very large chunk of or overall portfolio. So typically we suggest that ESOP should not be more than 20% of your total net worth. So we should keep it in a way that it don't become as a large allocation of the overall wealth. As it the size and the value grow, it has to be diversified across different investment options, so that when need come, we don't end up taking a wrong decision, because it may not necessarily that time markets are in a good condition, and especially in a scenario where today globally we are at peak of the interest rate. We can see a lot of global uncertainty can come, which can impact all these large companies, especially on the global side. This is the one interesting example just to showcase that these are one of the best companies we look at from the India side and on the global side, that how they have delivered returns. But if you look at some of the companies have gone through a bad phase also in a short period of a time. Amazon is the best example if I look at from the global side. Same way, if you look at on the Indian perspective, I think Infosys currently going through a bad phase of thing, and Wipro comparatively always been on the underperforming side if you look at on a comparative level. So this particular thing shows that yes, ESOPs work very well, but the company how it is doing that also play a major role. So sometimes doing a diversification help a lot than holding same set of companies, because over a longer period of a time, what we have seen that wealth creation is all about asset allocation. It is not about just holding a one stock, because you may not write all the time based on the way things are changing. So we want to give a one real time example that what we did for one of our client, and how we have added value in the overall perspective. He hold SCL tag ESOPs where one thing where it's that okay, the way he was managing, we continue to manage in the same way, that we just hold those ESOPs without doing any sort of changes. The second strategy, what we did is that we did a phase exit and reinvestment into a diversified portfolio, which includes PMS, AIF, and mutual funds. So, if you look at the whole strategy of diversification and with the phase exit, has helped to generate a double of the return what if it would have taken generated without doing any action. So sometimes people may see that uh, taking no action is not a good thing, especially on the tech side of the thing, because their things are changing very dynamically, especially and when you want to take a decision, it may not be an ideal time also. So it's always make sense to take a professional advice and diversify based on the phase entry and exit. So the way entry make a most important part to reduce the tax outgo. Same way exit also play a very major role. So typically we don't suggest that you do a complete exit, but at least diversify a part of things, so that how you can increase your overall returns. Because there are times, if you look at like last 1 year post COVID, if you look at technically, overall market did well and IT has underperformed because of the global reason and earlier up move. So someone who have planned well and diversify his portfolio post COVID, it added a lot of value. So typically we believe in the contrarian approach, that buy in the bad times and sell in the good times, because that is something which help investor then following the herd mentality of doing things when they are in a good shape. So the next part come, okay, how the ESOPs are taxed. So this part also many times people have a thing that okay, company has paid the tax, so now there is no tax implication. But today, if you look at there, we have to pay the tax at both the time. One at the time of the exercise of the option. Second at the time of selling of the shares. So, how the tax treatment works. So, in that also there are two parts: if company is listed or unlisted, because that is going to be the deciding factor that how the tax liability is going to be. So, for example, for the companies which are listed, based on the exercise price and the fair market value, the overall tax liability will be considered for the short term purpose. And so same way, if I look at shares which are listed, and from a long term perspective, how the tax liability is be considered. So as per Indian tax law, if you look at short term for the listed company is 1 year, and long term is after 1 year. So before 1 year, if somebody is exiting, it will have a 15% short term capital gain, and after 1 year, it will be have a 10% tax on above 1 lakh of overall capital gain. And in case of unlisted shares, it will be 15 with short period will be added to income, and long term will be 20% with the indexation. So typically, if you look at for listed or unlisted, on an average tax liability come around 10%, because after indexation, 20% with indexation make around 10% tax liability, even for the unlisted case also. But the only thing, the time period for unlisted, instead of 1 year, it will be a 2 year for a short term purpose, which is for listed case, it's been considered as a 1 year. And the whole calculation has been done on the fair market value. So, for example, if you look at in this case, fair market value was 150, and when they have sold, it was 165. So that point of a time, whatever be the difference on that, short-term capital gain will come on the gain part. And second case where fair market value is 30K overall gain, because overall gain is below 1 lakh, so there is no tax liability. This is a brief on the taxation thing. 10% for long term for listed, short term 15%, non-listed case long term 20% with indexation, and short term gain added to total income. I think that this is the most important part based on our experience. What we can say that one mistake normally what investor do it, selling their investment to paying the for the tax. So that is something which is the strategy which I have suggested, that either create a one liquid pool or use max gain type of account, or taking even a loan against securities, especially like mutual fund stocks, where you can get a at a 10% level loan. If there is no condition of prepayment, it makes a lot of sense. Second mistakes, normally what we have seen that non-phase entry and exit. So they just try to do one time exit, which typically doesn't work out, because what we normally say that when markets always do both the side extreme, when stocks are moving up, they move extreme one side, and when they are going down, they move extreme on another side. And what we have seen that the moment somebody exit and after that stock move up, he stopped taking a further exit, thinking that he has done the wrong decision of exiting a particular stock, which is not a right approach. So what we say that typically for entry and exit, we give a 3 entry and 3 exit levels, because obvious that you will never able to identify the right price, what would be the ideal. It's only makes sense that based on the overall long-term technical and the fundamental view, because liquidity play a very major role. So when markets in a euphoria zone, stocks may move 30 to 40% higher, or even a 2x higher than what is their real value. So it's always makes sense to do it instead of doing it one shot entry and exit. The third part, non-diversification. So normally people have view that okay, I am holding a stock in the sector where I am bullish on the sector. So they may not go in detail of the company fundamental. They are more bullish on the sector side. So typically, our views that even if you want to look at on the sector level call, it makes sense to buy the sector fund or buy a bunch of good quality sector stocks than buying a one particular company. So I think we have seen the example of Wipro that instead of holding Wipro stock, even somebody have bought the IT sector index or buying a 4 5 good quality stocks on the IT side, it would have created a more wealth creation and reduce the overall risk also on the lower side. The fourth most important part, which comes from a compliance part, which many times get ignored and impact heavily, especially on the insider part. So I think that's the most important part, which we normally say somebody needs to consider, because many times what we have seen that uh, when stocks are traded, many times they have not given an intimation to their PMS house companies, mostly in the or even the broker, that they come as a part of insider, and they lose out and get impacted heavily from a compliance perspective. So it always makes sense to get a written letter and specifically give instruction on the case when someone holding ESOPs and where the insider regulation come into the picture. The fifth and the most important part, if I look at on the advanced tax side, so typically what we have seen that at the time of tax filing, which is currently going on, suddenly that time people get a thing that oh, I am unnecessarily paying tax, and over and above that, I end up losing some 10 to 20K as a penalty, which is really can avoid it if you plan it well. So whenever if someone is selling on the larger volume on the ESOPs, we always should pay the advance tax so that we don't end up losing as a penalty amount, because today we end up paying 1% of the tax as a penalty every month, which is very high. And the last part, which is normally people do it, ESOPs money allocation instead of gold moving to the real estate. So to save the tax, one thing people do it, especially where they have a larger volume value of the ESOPs proceed comes, they just move into a real estate thinking that okay, I am saving the tax, instead of looking at their goals and the overall long term plan. Because yes, putting in real estate you may save one time tax, but the whole objective of achieving your goals and the capital growth which will be taken for the granted. Because today if you look at real estate as a whole, maybe give 4 to 5% overall gain including rental and the appreciation, which compared to any diversified portfolio which can generate 12 to 15%. So in the long run, if you look at taking an emotional decision just based on to saving tax at now, they lose for the lifelong, because the appreciation will not come. And secondly, most of the time they end up buying properties for their own purpose, so that they don't have even an investment return also. So that is also the most important part. First somebody needs to look at their goals, then take the overall call that where they should allocate the money. Recently, government has made some changes on the startup side, ESOPs taxation, so wherein they were provided thing that at the time of the expiry of 48 months or from the date of sales shares, or taxpayer sees to employee of the startup, they can any of the following event, they can exercise and pay the tax instead of paying tax at the time of the vesting. But the only condition that the startups which are eligible, so it is not for all sort of startups, but yes, if any of the startups which are eligible startup, for them at least the at source tax can be saved. Because many of times what we have seen that in startups employees get ESOPs, but the major point come how to create a liquidity. Because what we have seen, many startups get failed over a period of a time, so they end up losing on paying tax at the time of grant of the shares, but they are not able to liquidate. So even to invest on the ESOPs also, it is not that everybody should do it without looking at their pros and cons. Because company growth play a very major role in a deciding factor that how they have to allocate. Because end of the day, even they are given at a zero cost, but they have to pay a tax on the based on the fair market value at the time of vesting. So that also play a very major role, especially from the startups perspective. Because many a times we don't realize that the real value is only when you exit. Otherwise, it's just a notional gain which is on paper. Sanjay, can we take a Q&A poll?
Hello.
Yes, Sanjay. Can we take a poll so that at least we can?
Yes.
Yeah. So we have kept one poll just to get a thing that how taxation works. Because as of now, I had talked about a lot about tax. Now I want to see that how it works and what people thought. Yeah, to give a recent, like Flipkart recently did a buyback of shares, and many of the Flipkart employees have seen that they got the benefit of this phone pay separation, where Flipkart has buyback existing shares. Yeah, I think it's what we have seen. That is the beauty of the taxation, that it always make confused. So if you look at the poll answers, it's divided one third almost. So everybody have a different views. That is the reason where the professional advice make a lot of sense, that because there are a lot of clauses which makes confusion. So in this case, because companies buying back shares, so there will not be any tax implication for the employees, but company has to pay 20% tax on the same. So answer would be 20%. Thank you. So that's the whole idea of this poll, that even we go through so many things, we have a lot of information today available, but getting a right information itself is a question because of the over information availability. Now the next part come how we somebody can save the tax. So especially when somebody got a large sum of value in terms of ESOP money. So another thing which will come section 54F and section 54EE, wherein they can invest, or section 44EE, wherein they can put money into certain specific investment to save the tax. So how this particular option works? So typically, long-term capital gain for unlisted it is 20%, and for listed 10%. If somebody want to save tax, they can invest into the real estate also. But the only challenge is that there are certain conditions which somebody needs to fulfill. So a person should not own more than one residential property, and apart from that, he should not sell the investment within 3 years. So, and last budget, because many of the ultra HNIs use this section to buy luxuries properties. So government has put a condition that maximum up to 10 crore only somebody can utilize. Up to 10 crore only they can invest, not beyond that from a tax saving perspective. So they have put a limit also, that up to that much value only property can be invested to save the tax on that purpose. So to summarize all the things, I would take one more example, that how different funds or stocks have done it in a different point of a time, and how the respective index have done it. So what we have seen, that it is not always holding a stocks only add value. If you look at Nasdaq is the best example for the technology side, where if you look at the returns of the index, they are much better than if you look at any of these stocks per se over a longer period of a time. So it's always makes sense to diversify, put into a different allocation. And if I add many of that funds also, they would have done it better than holding into these stocks. So the whole idea is that diversification always add value, because we don't know when company go through from a good cycle to a bad cycle, where Amazon is the best example. If you look at last 5 years of return is hardly 8%. So but if you look at 10 years, it did very well. So last 5 years is a bad phase of market. Same way Wipro also has gone through the bad phase of the thing. So that is the whole idea, that diversify investment and follow the asset allocation. To conclude, I'll just take you through all those points in simply way. What are the things which somebody should look at and plan it from a ESOP's perspective? One is, don't take any decision just based on the taxation, buying a real estate or something. Look at your goals. Second thing, when you are doing a vesting of your shares, don't sell your investments and fund it. Plan it well in advance. For that, you can use three different way. One is, you can create a liquidity, maybe your emergency fund, which you can use it and replenish back. Second thing, you may take loan against securities for a short period. Third thing, someone have a loan, if he's taking through max gain, would be an advantage way. They can use money from there and put it back again once they exit from those stocks. So that was the second part. Third part, don't do one-time exits. Do a phased entry and exit, because nobody can predict what will be the ideal level for entry and exit thing. Only based on the overall assessment of fundamental and technical, we can come out with the range. So typically, we give three entry and exits. And the fourth is the most important part, is that follow the asset allocation and diversify your portfolio, because at a different point of a time, different asset class work. So, for example, when Indian stocks are doing good, global IT may not do good. There will be a time when gold will be doing good. So, there will be a make sense to hold some allocation on a debt or a dynamic funds. So, it's always make to diversify, because each asset class work in a different point of a time. And the most important part, all your investment decisions should be based on your goals, not based on your returns or taxation or another thing, because everybody have a different risk tolerance, which is the most important part, which many a times people ignore, that you cannot take a decision based on what somebody else has taken decision, because everybody have a different risk tolerance. Secondly, don't consider ESOPs that it's given at a free cost, so it's not worth it. It could be a real major part of your wealth. So always do a regular review of your portfolio. Take a professional advice and understand how company is doing. And based on that, you should take a call on to hold or not just to hold it without looking at the fundamental of the company. So the way you review your all other investment, you should review your ESOPs also, and understand from the expert that how this particular company is doing, because maybe you being an insider, you may not able to get a different view of from the financial market perspective, because that is a completely different thing altogether. So it's always makes sense to get a third party view from the investment perspective, and look at all sort of a transaction cost and the diversification as a whole before taking any call. So that's all from my side, Sanjay. So we can end the session where we can have a Q&A.
Yeah, thank you, sir. Thank you for sharing the valuable insights. I think we are already having few questions in the Q&A and chat box. Meantime, I would like to request all the participants to post their questions and in queries in the Q&A section. We will be taking it one by one. So, sir, the first question uh, is ESOPs and RSU are same?
See, ESOP, employee stock option and RSU restricted stock option. So, based on the overall allocation level, it depends. So, RSUs are similar to ESOPs.
Uh, Thank you, sir. The next question is there any tax implication after ESOPs has vested or only when we exercise?
So, as discussed earlier, ESOPs taxation are both the time. One is when they are vested. That time, somebody has to pay 30% tax on the difference of the fair market value basis and the cost at which is given. And secondly, when they exercise and exit, that time also they pay. So, both the level tax implication will come into the picture.
Thank you, sir. The next question is how are ESOPs dividend taxed?
Yeah, ESOPs dividend are taxed. Only one good thing is that, for example, somebody holding a global company ESOPs, if tax has been deducted there, so based on the tax treaty, DTA treaty, somebody can take an exemption in India. So you don't need to pay tax again in India for the same, but for that he has to do a disclosure and provide the required detail. But dividend are taxed today even in the India and the global perspective also. It is added to income, so based on income slab it will be taxed.
Thank you,
There
sir.
should not be a double taxation. That's the main thing which somebody needs to consider. If he has paid a tax in the respective country, for example, if somebody hold a US based company ESOP and they have deducted at source tax, then you don't need to pay tax in the India.
Thank you, sir. The next question is If an organization is going for ESOPs first time before listing, how the employee be prepared and what are all items to watch?
Yeah, I think when the most important part which employees needs to look at what is how they are planning to take the call on the exit side, because many times what we have seen that when company go for the listing, it because of the market sentiments it move. So many times people just continue to hold thinking that whatever up move has come, it will continue in the same way. That may not be the right approach. And we have seen many of the SaaS companies which have recently listed in the US market from India, they had a very good listing, and after that they have corrected significantly. So they should understand the base valuation parametrics, that what is the valuation which is expected. If it's going beyond that, then they should take partially exits also. So they should not just look at to hold it in the euphoria market. And we have seen India also during IT bubble in 2000 how IT companies have moved, and after that for next 10 years they have not made returns for the investors. So there always be a bubble zone which comes for most of the companies in the overall level. So it always makes sense to take prudent call not to go with the whole up move cycle.
Thank you, sir. Mr. Viral V is having one query. Once the employee get the money for ESOPs, they have to add in their income and pay the taxes as per slave rate. Am I correct?
Yes, once they are able to, once they sell it, they have to add based on the capital gain level. They have to add in the income and they have to pay the tax. Most important part in that, it is not at the time of filing. You have to pay the advance tax. So that's a one mistake which most of the time people do it, that when CA come up with that, okay, this is the one entry of income which has come, and after that they take a call that what needs to be done. So it is not at the time of filing, it is at the time of getting a sales proceed. So once you exit, then you should put it as an advanced tax payment so that you don't pay the penalty on the same.
Thank you, sir. The next question is, what's the rebalance strategy to manage risk within portfolio?
Yeah, so the rebalance strategy will be that don't not to put in the same basket the allocation. For example, somebody hold a tech company stocks. For them to invest into a non-tech stocks will add value to diversify his portfolio. So tomorrow, for example, if overall tech is not doing good, the other part of stocks will reduce the overall risk. And secondly, they will not have a company specific risk. So tomorrow, if anything happen to one particular company, so there are two level you can reduce the risk. One is reduce some part of allocation on the sector, then holding on the company. Second is put money into a non linked sectors. Like he can put it into a more on the diversified portfolio than putting into same IT sector.
Thank you, sir. The next question is, let's say an employee shift to Dubai where there is nil tax liability on ESOPs vested in US and makes a transaction. Will it be taxable in India?
Can you repeat what's the question? If employee shifts in Dubai, what will there will be nil tax liability on the ESOPs listed in the US? Because it will be taxable in India. So it all depend on that time what is his tax status. So if its tax status is in Dubai, then he not need not to pay. So in India, taxation depend on the tax status basis. When he's filing the tax that time, what was his tax status?
Thank you, sir. Do you suggest exercising ESOP before company list for tax saving purposes?
No, it all depend on the company performance, because If overall view is that company is doing good, it makes sense to exercise it before, because after that you may end up buying at a higher price. So only one thing which you have to look at, there will be a taxation difference will come in terms of the taxability perspective, but it makes sense. I think somebody to exercise before that add more value in the move.
Thank you, sir. And the next question is, basically, can founders or other investors decide on whether they want to give you an option to exercise your vested shares, given that you have moved out of the organization? Let's say an employee buys his vested share. Is there a way for him to ensure he can liquidate in the next funding?
See, most of the times it depend on the ESOP policy, and normally founder exit their stakes, then employees doing it. So it all depend on the ESOP policy. So if there's an option that employees also can participate, then only they will have a right. So typically it all depend on the ESOP policy. So somebody has to have a discussion on the ESOP policy perspective. Based on that only it can be decided.
Thank you, sir. The next question is, my company is offering ESOPs, but I don't know anything about ESOPs. How should I go about investing?
Yeah, so I think maybe you can discuss internally with their CF at your investment committee there, or you can take a help of a professional advisors who can help you to take a right call.
Thank you, sir. The next question is, what is the pre-clearance before sale of ESOP? Is there any amount set by SEBI for pre-clearance?
No, there is nothing as such that amount set by for pre-clearance perspective. Only thing what is required that you should be have, for example, if you are exiting your ESOPs, you give their detail in terms of, especially for the NRI's case, that it has been allocated as a ESOP, so that on the TDS part, it will not come into the issue. Otherwise, for resident Indian, it will not be an issue. They can do exit without having any sort of a pre-clearance. Only for NRI, they have to be very particular that they give the ESOP letter before doing exit, so that they don't end up paying higher tax.
Thank you, sir. I think we have last two questions, so I will be reading out both the questions. What are the blackout dates for sale of ESOPs?
It all depend on the company based on their financial results, and based on any sort of a company specific thing is there. That time they keep it as a blackout period. So that time you cannot exit those stocks, especially people who are the insider.
Thank you, sir. So the last question I will be reading out. For employees of US US companies, how would the dollar to NRA exchange rate affect the time of exercise of option? It's expected dollar would appreciate, so if better to factor that in the exercise now. So I think that is more the
uh,
question.
if you look at the long term level perspective also, the USD to INR, the overall impact will be 2 to 3%. But I think the stock price move will be much more higher, which will be typically 20 to 30% move. So I think currency should not be the deciding factor, because the impact will not be in a very large extent. And especially in a current scenario, if you look at, we don't expect that dollar continue to dominate. So you will see that even if you look at this year also, rupee is appreciating. So if you look at from a current scenario perspective, we are not advising someone to look at the currency part, because we don't see that the dollar will continue to be an uptrend from here, at least the way things are changing globally and India perspective. So at this point of a time, we don't suggest to take a currency call, and look at on more on the stock price basis, how stock is moving, and then take a call. And if
Thank you.
you so you can share, if you have any other questions, you can write a mail to us, and we have expert team which works only on the ESOPs, and we have a very long track record of managing ESOP money through our PMS also. So you can reach out to us and we'll be happy to help.